Hey everyone, for those of you with not too much money to invest and using a brokerage that doesn't allow for fractional share buying, this video is for you. I've got three relatively cheap growth stocks selling at less than $25 each that you can buy today. Not only are their prices cheap, but the valuation is cheap. I'm going to share with you what these three stocks are and the reasons why I like them and recommend them as buys. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the first stock in this list of three is UiPath. It's trading at a price of $19.34. It's down from over $75 per share in July of 2021. And the combination of automation and artificial intelligence is going to help UiPath increase its customer growth. Now, the company has done a good job growing its revenue over the last 5 years, as you can see here. Revenue has jumped up to 1.31 billion, and that growth in revenue has also increased the company's cash flow from operations to sales metric, which stands at 22.86% in the most recent period. I like companies that grow profitably, grow in a way that enhances the business and not to the detriment of the business. There are many businesses that find it easy to grow, but fewer businesses can grow and improve the business at the same time. That's difficult to accomplish because now you have to offer your service to customers effectively and efficiently in order to drive profitable growth. Otherwise, every dollar of sales you generate, if it's costing you $2, $2.50, you're going backwards. You're losing more money the more you grow, and that's not effective. I don't like those kind of companies, and I typically don't recommend those kind of companies. UiPath is not one of those. They're growing revenue, and you can see as their revenue has growing, they've been improving their metrics, their cash flow from operations to sales, and other critical metrics that I'm not going to go into detail here, but that I've evaluated and I've followed for several years. So if UiPath is on the right track, and it's trading at a forward price to earnings ratio of 28.26. Now, this is an important distinction to make for investors. When you're looking at a company and its market price, the price doesn't tell you if it's a good value or not. You can have a company that's trading for 55 cents or 65 cents, but that doesn't mean that it's cheap. What makes a company cheap or expensive is not the market price, but what you're getting in return, the valuation. And to determine valuation, you need to use metrics like the forward price to earnings ratio, or the price to free cash flow ratio, or the price to sales ratio. This measures price on the numerator, and the denominator is something you're getting in return, whether it be sales, cash flow, earnings, something on the denominator that you're getting in return in exchange for the price that you're paying. That's what determines value. That's where I see many investors fail to take that second step and look beyond just the market price. Look at the valuation ratios, and you'll be able to tell whether or not you're getting a good value or not. With UiPath, you are. You're getting a forward price to earnings of 28.26, which is a good value for a company with its growth prospects and its characteristics. The next stock I'm recommending here at less than $25 is StoneCo. StoneCo is trading at a market price of 15.32. The financial services company, based primarily in Latin America, has also done a good job growing revenue and growing profitability. You can see its trailing 12-month revenue has jumped up to 2.142 billion, and you can see it moving in the right direction here in terms of profitability on the bottom line, jumping quickly from negative 600 million in profitability all the way up to 203 million for a net profit margin of roughly 10%. So it too is moving in the right direction in terms of profitability. Management in recent quarters has implemented a more focused growth strategy, saying that they're going to go after more profitable customers, and this prioritize the less profitable customers. And I like that strategic shift, going after these customers that you can serve more cost effectively and thereby generate better profit margins, right? So I'll give you an example of this. Let's say you have a business and it's a physical business in, let's say, Los Angeles, California. And let's say your business relies on people being close to your location. So the most profitable customers for you would be people that are close to your location, within a few miles, let's say. And less profitable customers may be a little bit outside of your area, right? Maybe not in Los Angeles, but maybe in Orange County, right? Sure, you can go after those customers so that you can grow the business, but those customers in Orange County will be less profitable for you because the cost to serve them will be much higher. The cost to serve them because they're so much further away. Maybe you've got to drive longer distances to make that delivery. Maybe you've got to expend more resources to make that sale. Whatever the case might be, those customers that are further out are less profitable for you. So for that business, it would be more effective to go after those customers that are in closer proximity and maybe selectively choose not to go after those other customers, and thereby keep your business healthier and not go after those unprofitable customers. So that's similar to what StoneCo is doing, even though it's not a physical business. The fact that it's going after the more profitable customers, this means customers that it's able to serve at a lower cost. And whatever the lower cost factors are for StoneCo, it's focusing on those customers it can serve at lower costs. And StoneCo, again, let me remind you of the valuation metric that we talked about, the forward price to earnings. StoneCo is trading at a forward PE of 9.891. So not only is the stock trading at less than $25, but the valuation is also relatively cheap. So I like StoneCo. That's the second of the third stocks. And last but not least, Snap, parent of Snapchat. It's trading at a market price of $11.01 as of this trading. Snap, again, like the others, has done a great job increasing revenue and boosting cash flow from operations to sales as revenue has increased. Trailing 12-month revenue of $4.6 billion, and that's increased its cash flow from operations to sales to 5.35%, all the way up from negative 30% in 2019. Again, one of those companies that's making choices to focus on the core business. It decided to let go of many employees and focus on core projects, and it also exited some other projects that it was pursuing that was not core to its business and thereby less profitable and more of a long shot. It could lead to big gains in the future, or it could have not led to big gains in the future. I don't like companies that are, especially, Snap is relatively new to generating cash flow from operations. Only recently has it done positive in terms of cash flow from operations. I would like it to focus more on its core category, make that core business stronger, build those competitive advantages before you look to new opportunities to grow outside of your core business. And I like that Snap management has shifted to that strategy in recent quarters. Now, Snap also is trading at a relatively cheap valuation, a forward price to earnings of 29.4. So all of these three stocks that I've highlighted, not only are they selling at less than $25 per share, but they're also selling at relatively cheap valuation in terms of what you're getting in return in regards to earnings per share. So these are three stocks that you can buy for less than $25 each. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.